Welcome back. Today we're breaking down 3 investment mistakes that quietly destroy wealth. Mistakes I see all the time. These aren't just rookie errors. Even experienced investors fall into these traps and lose out on huge gains. Think of your financial plan like a house. Even the best design fails if the foundation is cracked. My goal? Show you how to avoid these cracks and build real lasting wealth. Let's dive in. Mistake number 1, and it's a big one. A mistake that can cost you dearly in the long run, is waiting too long to start investing. It's easy to put it off, isn't it? There's always something else that seems more pressing, more urgent. A new phone, a weekend getaway, paying off those pesky credit card bills. But delaying your investment journey is like delaying planting a tree. The later you start, the less fruit you'll enjoy. The magic of investing, the real secret sauce, is compound interest. It's not just about the money you put in, it's about the money your money makes. And its secret ingredient, the catalyst that makes it all work, is time. The more time your investments have to grow, the more significant the impact of compounding becomes. Think of it as a snowball rolling down a hill. It starts small, but as it gathers momentum and snow, it grows exponentially. Here's a quick example to illustrate the power of time. Alex invests $200/month starting at age 25. He understands the importance of getting started early, even if it's just a small amount. Ben, on the other hand, waits until he's 35, perhaps feeling more financially secure, and then invests $400/month, double what Alex invests. He thinks he's catching up, making up for lost time with a larger contribution. But by the time they both reach 65, Alex, the early bird, has accumulated far more wealth. And it's all just because he started earlier. 10 years can make a monumental difference when it comes to the magic of compounding. The lesson here is clear. Starting small and early consistently beats starting big and late sporadically. Consistency and time are your greatest allies in the world of investing. Don't underestimate the power of small contributions. Even $20 or $50 a month can make a significant difference over the long term. It's not about getting rich quick, it's about building wealth steadily over time. The habit of investing regularly is far more important than the specific amount you invest. It's about building a financial discipline, a routine that will serve you well throughout your life. Every single day you wait to start investing, you lose out on potential effortless growth. You're essentially leaving money on the table, missing out on the opportunity for your money to work for you. Remember, your biggest asset when it comes to investing isn't necessarily your current income, it's your time horizon, the length of time you have to invest. The younger you are, the longer your time horizon, and the greater the potential for compounding to work its magic. The earlier you start, the more you benefit from the power of compounding, that snowball effect that can transform small investments into substantial wealth, and the less risk you need to take later in life to reach your financial goals. Starting early allows you to take a more conservative approach, knowing that time is on your side. So don't wait for the perfect moment, the moment when you feel like you have enough money or enough knowledge. That moment may never come. Start now, today, no matter how small the amount. Even a few dollars invested regularly is a step in the right direction. Trust me, your future self, the one enjoying a comfortable and secure retirement, will thank you profusely for making the decision to start early. Mistake number 2, a classic pitfall for new investors, putting all your eggs in one basket. This is a concept as old as investing itself, and for good reason. It highlights the critical importance of diversification. Betting everything on a single stock, a single asset class, or even a single sector isn't investing. It's speculation, plain and simple. You're essentially making a binary bet. Either this one thing goes up, or you lose a significant portion of your capital. It's gambling. And while there's nothing inherently wrong with gambling, it shouldn't be confused with a sound investment strategy designed for long-term growth and financial security. The odds are stacked against you when you concentrate your investments. If that one company tanks, faces unforeseen challenges, or an entire industry sector declines, your whole portfolio could vanish, or at least suffer a devastating blow. This is the risk you take when you fail to diversify. It's a risk that's simply not worth taking. Diversification is your safety net, your insurance policy against the unpredictable nature of the market. It's about mitigating risk and ensuring that your financial future isn't dependent on the success or failure of a single entity. Spread your investments strategically across different sectors such as technology, healthcare, energy, and consumer staples, and across different asset classes including stocks, bonds, real estate, and commodities. Index funds and ETFs or exchange-traded funds make this diversification process incredibly easy and accessible, even for beginner investors. They offer a simple and cost-effective way to gain exposure to a broad range of assets. With a single purchase of an index fund or ETF, you get exposure to hundreds or even thousands of companies across various industries and sectors. This instant diversification significantly reduces your risk. When one area of the market struggles, as inevitably happens from time to time, another area can pick up the slack, cushioning the impact on your overall portfolio and helping to maintain a more stable and consistent growth trajectory. Diversification smooths out the ride, reducing volatility and protecting you from the potential for catastrophic losses. It allows you to sleep soundly at night, knowing that your financial future isn't hanging by a thread. Don't chase the next big thing, the hot stock tip, or the latest get-rich-quick scheme. These are often traps that lead to significant losses. Instead, focus on building a balanced, resilient portfolio that can withstand market fluctuations and deliver consistent returns over the long term. Slow and steady, with a well-diversified portfolio, wins the wealth race. It's a marathon, not a sprint, and diversification is your key to endurance. Mistake number 3, a very common pitfall that many investors stumble into, is trying to time the market. This is the illusion that you can predict short-term market movements with enough accuracy to consistently buy low and sell high. It's tempting to think you can predict, based on news events, economic indicators, or even just a gut feeling, the perfect moment to buy or sell, maximizing your profits and avoiding losses. You might think you can anticipate the next market dip or the next surge. But the reality is, even the pros get it wrong. Professional fund managers, with all their resources and expertise, consistently fail to outperform the market over the long term. And missing just a few of the market's best days, those unexpected surges that often follow periods of downturn, can have a devastating impact, and your returns can be cut in half. The market tends to have its best days clustered together, often right after the worst days. So, what's the real secret to successful investing? Time in the market consistently beats trying to time the market. It's about long-term participation, not short-term speculation. Invest consistently, regardless of market conditions. Don't let fear or greed dictate your decisions, no matter what the headlines say. Ignore the short-term noise and focus on your long-term goals. Dollar-cost averaging. Investing a set amount regularly, whether the market is up or down, removes emotion and guesswork from the equation. It allows you to buy more shares when prices are low, and fewer shares when prices are high. Ignore the noise of daily market fluctuations. Stick to your plan, even when it's tempting to deviate. Discipline, not genius, is what ultimately builds wealth over time. It's about consistently putting in the work, making regular contributions, and staying the course. Trust the process and keep investing, even when it feels counterintuitive, rain or shine, through bull markets and bear markets. That's how you win long-term, by focusing on the fundamentals and letting time work its magic. To recap: start early, diversify, and stay invested. These simple habits are the foundation of financial success. Forget chasing hot tips, focus on a solid, repeatable plan. Your future self depends on the choices you make today. Avoid these mistakes and you'll be on the path to real wealth and freedom. Thanks for watching, subscribe for more tips, and take control of your financial future.